Welcome to our webinar on tax-efficient angel investment. My name is Kirsty Payton. I'm part of the entrepreneurial tax team here at Sheen & Tate. So firstly, a brief overview of what I'll discuss. I'll also provide my email address at the end of the webinar so that you can ask any questions that you may have. So firstly, we'll look at what is angel investment, how tax can help your idea be more attractive, and then how to get ready for investment. So firstly, what is angel investment? Various forms of angel investment. For example, there are individual angels who may have been entrepreneurs themselves, who have spare cash and are willing to invest in small startup companies. There's also syndicates of angels, where lots of individuals will come together to put together the money required. There's also crowdfunding, so people can go online to something like Seedrs or Crowdcube and invest very small amounts, as little as £10 in some cases. There's also other forms of investment if you didn't want to go for angel investment. There's reward crowdfunding, for example, a Kickstarter campaign, which also doubles up as a bit of a marketing campaign for your company. Bank funding. More and more high street banks are providing loans for startup companies, so it's worth having a chat with someone to see what advice is available and what they could do for your company. There's also loans and grants available from bodies such as Scottish Enterprise and Highlands and Islands Enterprise. And finally, there's competition prizes. For example, the Investing Women AccelerateHER competition. This could be a cash prize or simply an opportunity which represents money that you would have had to spend yourself and can save you a fortune in the process. So you've got to think about whether angel investment is the right thing for you. Think about the process. Think about the costs and the time involved. The process can take a bit of going forward between different people. You might have to work your way around various angel syndicates or various individuals to find the amount of money that you need and to get the right people involved in your company. It can be expensive. You'll normally need legal advisors, tax advisors, and your accountants will need to be on board to make sure you've got the right information to provide to your investors. So when you're thinking about how much investment you're going to need for your company, think about how much it's going to cost to actually get that investment and gross it up. It's also really time involved. So make sure you've got the right people around you to support you, to make sure that your company can run smoothly while you're out looking for funding, speaking to investors, dealing with lawyers, and making sure that you have everything where it needs to be. It's all about the support, so make sure you've got it. And finally, think about exits. If people are investing in your company, you've got to think about how long you want them to be involved in your company and how involved you want them to be. They may not always want to keep their money in for 10, 15 years. They may want to put money in, get the tax reliefs, support your company to the next stage, and then sell their shares and move on to their next job. So how long do you want them to be involved in your business, and how are they going to realise their cash? So one of the key aspects of angel investment is the associated tax reliefs, and that's what I'm all about. There's EIS, which is the Enterprise Investment Scheme, and there's SEIS, which is the Seed Enterprise Investment Scheme. These are basically ways for investors to mitigate their risk, and being able to invest under these schemes increases the probability of investors risking their money in your company. Both schemes are fully HMRC approved and government legislated. There's various key requirements for companies to make sure that they qualify, and these are put in place to make sure that the schemes are targeted at the correct companies. So let's have a look at some of the key numbers involved. In the top part of the table, you can see that under SEIS, each investor is limited to investing only £100,000 a year. That £100,000 can be spread over various companies or put into one company. Under EIS, each investor can invest up to £1 million a year into EIS companies. Under SEIS, an investor will obtain income tax relief in the first instance. This is at a rate of 50%. Under EIS, it's 30%. So you can see that SEIS is aimed at earlier, higher risk companies and therefore the tax reliefs associated are that bit higher to mitigate that bit more risk. Under SEIS, there's also a capital gains tax exemption. So for example, if I've sold a second property, I've got a holiday home in the south of France. I sold that property and I've made a £100,000 gain. I can exempt 50% of that gain. Normally I would be paying tax at 20% as an additional rate taxpayer. And so I would be saving 50% of that tax liability by investing under SEIS. This isn't available under EIS, but instead I can get a capital gain tax reinvestment relief. This means that by investing, say, £100,000 under EIS, I have deferred the entire £100,000 gain that I had into my new shares. If I then sell those shares, that gain would normally come back into charge. But if I keep reinvesting into more and more EIS companies, eventually that gain will completely disappear if I died. So although it's a timing benefit in the first instance, it can eventually become an absolute benefit. For the company, each company can receive up to £150,000 under SEIS. This is ever. There's no annual limit. They can only ever receive £150,000. But this limit goes down if you receive de minimis state aid. So it's important to have a look at that. I'll discuss this later. Under EIS, each company can receive up to £5 million a year, which is a huge amount of money. So you can see why companies take repeated rounds of investment to keep them going and to keep their cash flow up. Under SEIS, a company can have gross assets of up to £200,000 and no more than 25 employees. So again, you can see that they're smaller, earlier stage, higher risk companies. Under EIS, a company can have up to £15 million in gross assets and up to 250 employees. So there's quite a size difference there. So let's put this into perspective. I'll use the example I used before. So if I was to invest £100,000 into an SEIS qualifying company, I will immediately obtain income tax relief at 50%, which means I'll save £50,000. This obviously is subject to me having paid or being due to pay £50,000 in income tax. I've also sold my holiday home, as I mentioned, and I've made £100,000. I would normally pay capital gains tax at 20%. I'm saving 50% of that, so I'm saving another £10,000, which means that I've got tax relief of £60,000 by investing in this company. So the effective cost of my investment is £40,000. That's a massive saving. If I hold those shares for 3 years and then sell for a gain, I'll also pay no capital gains tax whatsoever on that gain. This is the main advantage to these schemes, because obviously each investor wants to make as big a gain as possible, and having to pay no capital gains tax is a win-win situation. Unfortunately, if the company fails next year, obviously nobody wants that, but there's a bit of a lift. Each investor can get a bit more tax relief. So again, you can see how we're mitigating that risk through tax reliefs. I've invested £100,000. As you can see at the top of the slide, I've saved £50,000 in income tax relief, and as an additional rate taxpayer, I pay income tax at 45%. So the other £50,000, which I haven't received tax relief on, I can get tax relief at 45%, which is another £22,500 saved. So total tax relief there is £82,500, and I've only lost £17,500 rather than a full £100,000. It's a much better proposition than simply losing £100,000, and you can see why investors would be more keen to put their money where their mouth is. If I was to invest £100,000 in an EIS qualifying company, I get income tax relief, as mentioned before, at 30%, so that's £30,000 saved. There's no exemption for capital gains tax, but I'm getting that timing benefit. So I won't pay tax under capital gains on the gain on my holiday home at the moment, but if I sell my shares in the future, then I would have to pay that gain. But if I keep reinvesting into more EIS companies, eventually, if I keep going until I die, I'll never have to pay that capital gains tax. So we'll use it as a timing benefit in this example, and say that I've saved £30,000 on day one by investing into an EIS qualifying company. Again, if I sell those shares after 3 years for a gain, I'm going to pay no capital gains tax. And then if it fails next year, the same applies. I've invested £100,000, I've saved £30,000 in income tax relief. So by applying my additional rate band at 45%, I can save another £31,500, and you can see total tax relief of £61,500, which means that I've only lost £38,500. So next, let's have a quick look at how to get ready for investment. There's certain qualifying requirements for SEIS and EIS. These can be quite intricate, and it's important to have a look at these or speak to an advisor who knows about the legislation and understands exactly what's required. We regularly speak to inspectors at HMRC to make sure that we understand any changes that come in so that we can advise our clients appropriately. So it's important to do a bit of a preliminary assessment to know whether your company is going to apply, or whether something needs to change, or whether a plan that you've made is not a good idea and it'd be more worthwhile to change slightly so that you can get SEIS and EIS for your investors. So as you can see on the slide, I've mentioned something called advance assurance. This is basically where we write into HMRC with all of the qualifying requirements and say this is why we think we've met them for this company. HMRC will then come back to us and say, yep, we're happy with what you've said, and we'll provide you with a letter saying we provide advance assurance that your company would qualify if you were to receive investment under SEIS or EIS. Most syndicates will require advance assurance prior to agreeing investment. So it's really important to think about advance assurance before you go and speak to investors so that you can get it into HMRC. Put in as much information as possible because it prevents any delays or queries from the inspectors. It can take up to 6 to 8 weeks for HMRC to process a request, so definitely get thinking now. Speak to an advisor or speak to someone who's been through it before. To put it into perspective, why do we need advance assurance? The way it works is that an investor would put the money into your company, so you have their money in your bank account, and then you'll go to HMRC with a form which is called an EIS1 and say, I've received this investment, this is how much I've taken, this is when we took it, and here's some information about my company. HMRC will look at all the information, decide whether you've qualified or not. And if you qualify, they'll come back with an EIS2, which is a certificate for the company and should be kept on file saying that you've qualified. They'll then also return EIS3s. These are forms which go to each investor and then get passed to their personal tax advisors in order for them to claim the relevant tax reliefs. So, as you can imagine, if you haven't got advance assurance, you go to speak to HMRC, provide the EIS1, and they say actually you don't qualify, the company already has the investor's money, and the investors already have their shares. So you could have some really disgruntled investors on your hands if they find out that they're not going to get the tax relief that they're expecting. It's also really important to make sure that you continue to comply with the rules of EIS and SEIS throughout that 3-year holding period that I mentioned, to make sure that the investors get their capital gains tax exemption at the end of the 3-year period when they sell their shares, and to make sure that they can keep all their income tax relief. If you fail to comply with all the rules, the income tax relief can be clawed back throughout that period. So get your knowledge up and keep it up throughout that time. So when you're getting ready for investment, one of the key things to think about is your share structure. Is it right? Do the right people have the right shares? Do the shares have the right classes? Do you want a different class for investors? Are your articles of association written properly? Do they have all the right information? In lots of startups, the founders will reward someone who's perhaps worked in the business or provided some kind of support to the business by giving them shares. But issues can arise here. There's not actually any such thing as sweat equity. Shares given for nothing or below market value are treated as income to an employee. and so income tax would be due on any shares received for free. This is under a regime called employment-related securities. Really complex rules apply, so it's really important to think about this and think about what shares you want to give to people. Is there a different way to do it that's more tax efficient? Again, speak to an advisor and make sure you know what's going on and you're happy with how things lie. Then we've got shareholder dilution. Obviously, with investment, you're selling shares in your company. By selling shares, you're going to dilute your position. So how much are you prepared to accept? We see examples like this in Dragon's Den, where someone goes in and says, I want £100,000 for my company, and I'll sell you 10%. And the dragons will come back and say, I'll give you £100,000, but for 20%. Thankfully, investment doesn't actually normally work like that, but it is a negotiation. So how much are you prepared to accept? Is there a rebalancing mechanism available? Could you use a share scheme? For example, the Enterprise Management Incentive Scheme. Put some performance targets in place so that although perhaps you've agreed that the investors can buy 20% of your company, you can renegotiate so that you can get 5% of the shareholdings back by using a share scheme in a tax efficient way, but also align your interests so that you're looking to achieve every target, and by achieving targets, you're getting those shares back. Just another thing to think about. Next, we have existing loans. Often in startup companies, the founders will put money into the company by way of a director's loan. These are normally an informal loan with no repayment terms. But obviously an investor isn't going to be too happy if they put money into the company and then find out that the investment funds are going to be used to repay that loan. It's basically a way of you having skin in the game and showing that you're as interested in this company as they are and you're willing to risk finance yourself. To make things nice and neat and tidy, and to alleviate any concerns of the investors, they'll normally expect that the loans are capitalised, which means that the shares are subscribed for instead of having a director's loan account. So you basically buy some more shares. Or maybe a loan agreement might be drawn up by some lawyers, detailing repayment terms, any interest due paid, and like I said, just making sure that everything's written down and agreed with all parties. So when you're getting ready for investment, think about your grants. There's so many grants available. Proof of concept, investor ready, smart awards. These can be a vital cash flow tool for each company to maximise any support and to make sure that you're at the right stage before you get investment. Perhaps you want to prove that your company can get to a certain stage in your financial forecast before you take investment, and grants are a great way of doing that. As I mentioned before, de minimis state aid is where this comes into play. Lots of grants are either de minimis state aid or state aid. De minimis state aid lowers the maximum amount of SEIS investment you can take. You can also only receive a maximum amount of state aid, but the limits are much higher. So keep a track of what grants you've received, when you've received them, and how much you've taken. As I mentioned before, also look at competitions. There's loads of cash prizes available, for example, Scottish Edge Awards, Converge Challenge, and loads of other competitions around Scotland and the UK. You might have to do a quick pitch video or submit a business plan. It can be quite daunting standing up in front of everyone, but normally it's what you've signed up to, so it's a great opportunity to get your name out there as well. Finally, you've got your business plan. I won't talk too much about business plans. My colleague Julia is also doing a webinar on business plans, and it'll be well worth a listen for some hints and tips on how to prepare the best business plan for your company. What I will say is when you go to speak to investors, you'll normally have to go through a gatekeeper if you're speaking to a syndicate in particular. They're not looking for a 50-page business plan to be able to get an idea of your company. They're looking for a quick teaser document which gives them an idea of what you do, why you do it, and where you're going. But it's important to put in some key information. For example, how much money do you think you're going to make? So some information in your financial statements, your profit and loss, your balance sheet, and your cash flow. If you're creating a teaser document, you'll normally have a longer document behind it, so you will need full financial statements for that document. But you can put the information into a small table in your teaser document just to give them a small idea of the financials and see what they're dealing with. Include information about what you're using their funds for, why you need their money. Who are your customers? What is your marketplace? What's your unique selling point? And what's your exit route? Just a couple of things to think about, but again, listen to Julia's webinar and she'll give you a bit more information. And I'm sure you'll be able to ask her any questions that you may have. So my final bits of advice. First, understand your share structure. Think about tax release well before you speak to investors. They'll normally be impressed if you know your stuff. Establish basic knowledge of SEIS and EIS. It's in your interests, it's in your investors' interests, and it'll make the whole process a lot smoother. And finally, keep track of all state aid received. It's not too difficult to keep a copy of any grant documentation, or just keep a small spreadsheet so that you know where you're at. Thank you so much for joining. If you've got any questions, please feel free to note down my email address, which is on screen, and email me at any time.